on our YouTube, I assure you will be uploading more stuff on crypto that you need on your daily basis. Just how to make some money on YouTube or how to make money from crypto mostly. So we'll be uploading those stuffs on YouTube uh, as time goes on. So this is today's public webinar, and in this two public webinar today is just what we are going to do, which is inducement. Now tomorrow we have other mentors in this ICE FS mentorship, but they are what they are master extra man. So thanks to you all, and thanks for those that subscribe to my channel. And if you have not yet subscribed to the channel, please do well and subscribe to the channel, and don't forget to turn on your notification. Don't forget to turn on your notification, and don't forget to share to your family and loved ones. So you'll be receiving a lot more from this YouTube. You'll be receiving a lot more from this YouTube. So those that are interested in learning crypto, other part of crypto like NFT and other stuff on crypto, will still be doing that. So that is that. The first thing that we will do today in today's webinar is we said we have what we call inducement. Inducement. And now, like let's say for example, based on what we have learned so far on our YouTube, we talked about inducement, we talked about market structure, and it was what straight to the point. So on those market structure I talked about, we said we have what we call complex and other stuffs on those things. Now, in today's session, what we'll be talking about is just how to trade structure continuation. How to trade what structural continuation. That means um, if you're on downtrend or in uptrend, just to understand how to join the trend. Simple way to join in joining with the trend. Now let's take for example, we have lower low, lower high, lower low, market create a lower high, lower low, lower high, a higher high, then a lower low. Now this always happen at what point of what interest? This always happen at what point of interest? You said this always happen at what point of what interest? Now, as this happen at what point of interest, and one thing you should notice as a trader, if you are trading structure, break or structure or other stuffs about structure, you deal with them with what point of interest. Now, market structure, liquidity inducement, and point of interest, four of them work together. Now you should know that liquidity and inducement, that give birth to structure, but it's structure that control both of them in market. Then point of interest is just to what have a define what value for them. Point of interest is what define them, so that you don't make mistake in them. Yes, you will make what tons of what mistakes as a trader, and you shouldn't be afraid of mistakes as a trader. It's part of the journey. It's part of the journey. Now, if this thing happen at point of interest, as market approach point of interest, let's say for example a single candle here, and this is our point of interest. As market approach this point of interest and give us what we call intent at point of what interest, that means market break structure at our point of what interest. It breaks structure at point of what interest, we call it what intent. So as market give us this break of structure at point of interest, we do expect what we call inducement. We do expect what we call inducement, especially when they give us what we call restructure BMS. And I believe most of you have uh, gone through our material to know more about range structure, though at least we have given at least 70% or 60% about range structure, and we are giving almost what 60% of what we do teach in the mentorship. But the remaining is how to use them. And I believe what I just teach them without what the combination on the YouTube. So I teach them what how to identify them on the chart and all. Then the main is what how to use them properly for your what trading, and some errors and other stuff. So that is that. Now, in today's session, these are what we'll be doing. Now, since we said that we have um we have our so since we said we have our what inducement at this high. So as market now induce this high, we expect market now to what? To continue the structure to the downside. We expect market to what? Continue the structure to the downside. So this is simple pattern of continuation. So this very high is this very high as inducement is this very high that you're seeing here. The market needs to what? To take. Now, this is just the idea of understanding the difference between inducement and break of structure. Now, since you're already in downtrend, you are not expecting market to make a new higher high. You are not expecting market to make a new higher high at that point. At that point. So since you are not expecting market to make what a new higher high, the 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 best thing is what how to join the trend. And not only joining the trend, not to join the trend at the wrong place. How to join it at the right place, because sometimes people can easily join the trend at a wrong place, then after their stop loss has been hit, then they will see themselves that the market is still going to their direction. Cool, it's part of the process. It's part of the process as a trader. You make mistakes, then experience will come into play, whereby you become what? Profitable. Now, as market has been creating lower high, lower high, and it has been giving us what we call either restructure, inducement, and the rest, which we believe we have given on YouTube. So restructure inducement happened here. That means this high has become a major what? A major high. That means a major high is a high that you're not expecting market to what? To read, or market to what? To take. So since you are not expecting market to sweep this high out, that means you expect market to continue the bearish flow. That means you expect market to continue the bearish flow without sweeping this very major high. Then this is what we call the inducement. Now, simple pattern of inducement is kind of head and shoulder. Whenever market creates what? Let's say, for example, this is the shoulder, then the head. After the head, it creates what? The right shoulder here. Then you join afterward inducing liquidity. This is simple. It's quite simple, and I believe most of you know this. At least it has what already given us what engulf this low, which is what we call a break of structure. A what? A minor break of structure, which I believe everyone used before they start changing it to another stuff. So that is that. Now we have this area as inducement. We have this high as the protected high that we're not expecting market to sweep. Now, after that, market give us what we call a minor break of structure to the downside. Market give us what we call a minor break of structure to the downside. Now let's see something here. Now let's take for example from here. Now as market gave us this, we go to like on lower time frame as it induced liquidity at point of interest. As it induced what? Liquidity at point of interest. Now you have what we call intent. That means restructure BMS at point of interest. Now before you calculate what we call BMS, there must be point of interest. Without point of interest, you don't have what? A reversal. So even if market now at unknown or at random place give you a break of structure, you don't consider that as what? A break of structure. It's not a what? A real break of structure. It's just to what? To trap you into the wrong side of the market. So the main idea is after noting your what? Your inducement, then you have to understand your particular point of interest so that you can easily read what? A real break of what? Structure. It can even be what? 1 pips or 2 pips to just notify that what exact point of what? Interest. Now we have what? An intent to the downside. We have our what? Intent to the downside. Now since we have intent to the downside, we are the most likely area you wait for price to what? To come into before you what? You take your entry. You wait for price at what? Your SC. Your SC at your what? Primary zone. You wait what? For price at what? Your SC at what? Primary zone. Now you can miss trade at what? At primary zone. You can miss trade sometimes. Now let's say for example here, wait for price at this SC just to join the downtrend since you're already in a what? In a downtrend. Now where are you targeting? You are targeting what? Your first what? Your first liquidity, which is this major low here. Why do we always target liquidity like this? You have the what? TP1, TP2, TP3. You always target liquidity like this in case market is not ready to take this low. in case market is not ready to take this low. So that means no matter what market will do, it must surely get to this point as far as it has already induced liquidity in the upside. It must surely get to this your TP1 before it reach this TP2, which is the final TP to the downside based on this time frame we are now. So now that means as market is coming down, you already know what you are doing, so that market will not take you unaware. So once you're able to target that major point of interest, market will not take you unaware again. Now this is our TP2, TP1, and we denote it as TP1. That is our TP1. So TP1, okay, that is our TP1. Now we expect market now to continue the bearish flow. We expect market now to continue bearish flow. Now market was able to come exactly at that at that SC, exactly at that SC. So this is just 2.2 pips. This is 2.2 pips, which is cool on this time frame at point of interest after having your intent. After having your intent, now you are targeting this low as your your TP1. Now after targeting this, boom, you expect market now to come to your TP1 before you expect anything else. So now market is giving us multiple entry, but we'll not be able to explain those things. But you can go to like some lower time frame to see what market is doing on these time frames. On this lower time frame, you see very clean setups on almost all time frame, and market is fracture. Market is fracture. So that is that. You have simple pattern to the downside. Now market was able to get to your TP2. Now as market is able to get to your TP2, now the next thing you look at is how market creates the structure within this long run here. Within this long run. Now this is where you go and learn more about structure, and which we have already given on YouTube. So you understand your major structure and minor and all, so that you not be mistaking what we call SMS leg from inducement. So I see some people that sometimes they can make mistake in marking the right inducement. They'll mark the wrong inducement. Market will not get up to their point of interest. Market will flow down. Now they'll think that maybe it's the inducement that is wrong, whereas they are the one that is wrong. So that is that. Now as market it has given us here, we have here as a minor break of structure, which is intent at point of interest. As market has given us has traded into this M1 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 SC. As market has traded into this M1 SC, you can easily see it, M1 SC. Let me denote it as M1 SC. Okay. M1 SC candle, that is our sponsored candle. You can easily see that. Now, as market has traded into this M1 SC here, now we have okay. Just a minute. Now we have our intent. Then it create a lower high. We have our minor break of structure here. Our minor break of structure to the downside, which is our intent at point of interest. Now market started creating lower low, lower high, lower low, lower high. So the first lower high that it was created, that is this high. That's our inducement. So you now wait for market to sell at this very particular point again, just to join the trend again. After inducement high, you have your valid point of interest. You have your valid point of interest. So the reason why that is a valid point of interest is what we call hidden quartz model on lower time frame. Though we have not yet given that on YouTube, but with time we'll be giving that on YouTube. I said with time. Now you target your next external liquidity from here. You target your next external liquidity. That is our bus stop. You target our bus stop from this very point. Since you already know what market is going to do next, you target your external liquidity to the upside. And we have gotten a little minor break of structure to the upside here. Now our concern is about the sell. We are not interested in this little buy. It's not that we can't take it. We can take almost all the whole the whole move within it. We have gotten the minor break construction to the upside. That means we are ready to what give us a corrective into the zone. But we are not what interested in that buy. We are interested in the major move. So if you know that the major move will come into play, what is the need of what of you trying to what to be taking all those little minor moves? So the major thing you are expecting market to take or you're expecting to take is what the major moves, where the what big boys come into play. So that is that. Now we expect market now what to give us the corrective wave. The same thing exactly. It traded into that inducement level, into that particular inducement level. So after trading into that inducement level, you expect what continuation, structure continuation. The same thing over and over again. You have what it was able to give us what we call a minor break of structure here again. After giving us this minor break of structure, which is this, which is our intent. But most times, what we call intent is when it's able at point of interest, when it's able to clear the whole range structure. We call that intent. So that is that. After giving us what our minor break of structure here, intent. Now you can easily go to what lower time frame, like seconds time frame. Now to what wait for market at what your particular point of what interest. At your what particular point of what interest. Your particular point of interest here is your what SC, your what SC as deep in primary what in primary zone, SC in what in primary zone to join the cell. You have gotten what intent to just to what to join the cell. You what wait for market at what the particular SC. Now you what you run with the big boys, you roll with the big boys till external liquidity is being taken, till external liquidity is being taken. So those are the things. So if you're able to miss the first sell move, you will not miss the second or the third, or you can even catch the third of them. Boom. You see that? It gives us a lower low, a lower high, which is what we call inducement. This high now become what? The major inducement that market need to what? They take. After that, now a lower low. Boom. Continuation of structure to the downside. Continuation of structure. Now you can see that market was able to give us here. This is one. This is one ratio. This is one ratio. What? The first trade we took there is what? One ratio 18. One ratio 18. So catching this or like two of these a week or even one of them a week is is good and fine as a what as a trader. It's not compulsory that you must be in the market every day. You can sacrifice what you can sacrifice 10 setup just for two major setup a week. That's just how you do it. Then you calculate your run. Because if you are trying to be in the market always, you will lose more. So you have to understand your own psychology, the type of person or the type of trader you are before you start what you start trading the way you want to what you want to trade. You have to understand yourself first. So those are the major things that you have to understand as what a trader. So after that, we expect market now continuation to the downside. Now you see that market click this low. Now we expect market to take the external liquidity, which is this low, which is this what this low. That is that. Now after taking this low, we have what we call internal structure. Internal structure, we have what our particular point of interest, our major internal structure, and there's a reason why this is what a major internal structure. So it was able to what grab somewhat liquidity. It was able to what grab somewhat liquidity, which was this high. Can you easily see that? Can you easily see the high? It dropped this high. So now after having this, your next point of interest where you will what expect market to continue the structure to the downside. The same thing over and over again. Your POI. Your POI what? To target what? Your next external liquidity. Your next what? External liquidity. The same thing over and over again. The same thing over and over again. So until market is what? Until market is not ready what? To the downside or you get what higher time frame point of what? Interest. The same thing. Now, same thing over and over again. You see here, you see what market did? It gave us what? It traded into that point of interest, into a particular point of interest. Traded into a point of interest, external liquidity as target. The same thing over you when you go to what on 15 seconds time frame, which you can easily see here. You see what market did here? It gave us a higher high as a range structure of this former range. After this range, okay. After this range, it gave us what? A higher high, a higher low, higher low, higher high, a higher low, then give us a new higher high. Then give us what we call intent at point of what interest on this time frame. Now, as it's giving us that intent, it was able to grab the whole range structure, which is the main confirmation of that what intent. Grab the whole range structure. It grabbed all. Now, the same thing over and over again. You enter at what your point of what interest to join the trend to the downside. To join the trend to the downside of the market. External liquidity is your what? Your next target. So if you couldn't enter at the exact entry, you are taking your entry with what called confirmation on lower time frame. Then you target your what? Your next external liquidity. You target your what? Your next entry at what? External liquidity. So now, as you are targeting the external liquidity, you must be what aware of what market needs to what to do. Now let's say for example here you have your external liquidity. Sometimes market can decide to what hit you at B. It can decide to what take you out. But at least once you're able to what to win with your what your risk to reward ratio, always, then you are what on the right side of the market. So that is that. The same thing. Okay, cool. Always. So if you would join again, the same thing, primary point of interest, which we have taught. The same thing, market just came back to what primary point of what interest, so that you can what easily join the trend again to the downside always. So these are the major things you need to what you need to learn as what a trader, and these are the major what challenges you have to what pass as what a challenge as what a trader. The same thing over and over again. You are always seeing that what confirmation on lower time frame. You're always what seeing that confirmation on lower time frame at point of interest. You can easily see it at point of interest. It will give us what that intent. That what intent. So the major intent is when it grabbed what the whole range structure. Same thing over and over again. Then you wait for market at what at the major point of what interest where you can easily join. Major point of interest where you can easily join the trend. The same thing here. Joining this trend at this area is very what simple. It's what simple, though a little bit what uh complicating to some, but it's what simple. Now you have this area higher high, higher low, higher low. Now within this range, you notice that this area was not what mitigated before, and this area has mitigated the what SC. So that means this last area that mitigate SC is your what your new point of what interest to join the trend, to join the trend to take what external liquidity what to the downside, to join the trend to take what external liquidity what to the downside. The same thing over and over again. The same thing over and over again. So you see how you're able to catch many intraday setups, many intraday setups on lower time frame with what you have on higher time frame, on lower time frame with what you have on a higher time frame. Now look at this little notice I wrote here. Now you can easily see at point of interest when market is able to what clear the whole range structure, you do expect what SMS, which is what we call intent. So at that area when markets, note what I'm saying here, this SMS, that is the leg that you are entering. What we call SMS is this leg that you are what you are using to enter. So we always like to what enter at those what SMS leg, not when it breaks structure majorly before other people want to enter. So we always enter before what they even see their own setup to what to enter. So that is that. Now in mentorship and in our weekly commentary, we do give more a lot of more and other stuffs on those session that we do even on our live session. So that is that. Please don't forget to share this to share our Zoom link tomorrow to your family and friends so that they can join and what and benefit from our what our trading class and our crypto class. And don't forget to what to share our YouTube channel so that they can easily what subscribe to our channel and turn on their what notification. So share our group. God bless you. Remain as you are. And secondly, we'll be giving what okay, tomorrow we talk more about that. We'll be giving what our giveaway tomorrow. We'll be doing a giveaway. Either we'll be taking what some people that are able to pass our challenge, we take them into the mentorship. They will learn freely from the mentorship or another challenge. So just be ready tomorrow. God bless you. Good luck. Good trading.